with Gurmeet Chadha, who's joining us today from Complete Circle. Gurmeet, hi, good to be speaking with you as always. Let's start with the market mood. Can you explain as to what's causing this consolidation in the market? Because clearly there's a lot of pressure as soon as we move towards higher level. There's a sharp retracement that happens, whether large caps or mid caps.
Hi Anisha. I think it's a combination of one event which is there on 4th of June. Different commentaries coming. It's a big event and which can create strain. So I think people have made good money in last 12 18 months. So family offices and HNIs we speak to, they want to keep some powder dry for the event. Although the odds of a repetition are higher, but politics in politics anything can happen. Second, have been a little technical with 10-year yields in US rising up and then obviously coming off a little bit. So as long as they remain above 4.5, it creates a bit of a pressure in terms of hot money moving in and out. And also the earnings have been a mixed bag, Anisha. So it's a combination of fundamental, technical, and event based. And if you see it, we are still 20 to 500. It's not that hell has broken loose. Mid cap index is still around 50,000. Bank Nifty is again, in the range of that 48, 49,000. So I don't think so. There's much correction except for, I think volatility is picked up, very rightly so. But I don't think so. Market has made up its mind this way or that way. I think the best hedge, as I keep saying, is good earnings. There have been a good earnings across and bad earnings within the same sector. FMCG, banks, IT, we have good and bad and poor numbers. I think stay anchored to earnings, and I think that's the best hedge going forward.
Okay, a confluence of factors coming together. But since we are talking about earnings, what's been your read through from the earnings of the FMCG companies that have come out with numbers as well as the private banks?
So, a couple of earnings we liked. I think Britannia reported very good. But the numbers were in line. But I think the guidance is what made the market, feel positive. I think they already grew 6% volume growth, and this is after we saw HOL and some of the other FMCG numbers reporting very tepid and muted volume growth. So high single-digit volume growth is well. The rural distribution reach continues to do well. Added more than 30,000 distributors again last quarter, and the market share is picking up. So now the nearest competitor is 0.7, 0.77 of what Britannia is. And a lot of categories, I think they're clearly leading. And then they are talking of adjacencies and synergies, right, in different products. A good outlook on the rural recovery, which I think is pretty positive. I think Tata consumer numbers were decent, especially on the margin front, although the tea had a bit of a market share loss of 30 bits, but their EBIT margins were 16%. I remember the company had high single-digit margins a few years back. So, the transformation continues for Tata Consumer. Private banks, I think Axis and ICICI clearly stood out. I think Axis, in fact, the NIMs actually went up marginally, although the credit cost remained high. Citibank synergy is now playing out. Deposit growth was pretty strong. ICICI Bank was, again, I think that the turnaround continues, and I think I've not seen ICICI reporting 2.4 to 2.6% ROAs consecutively now. I think 3-4 quarters I've been seeing almost 2.5% plus return on assets, and this is not just treasury income or recoveries which is aiding it. It is very structural in terms of NIMs, in terms of deposit growth, in terms of asset quality metrics. So I think these are the numbers which really impressed me, between these two sectors.
Gurmeet, I didn't get your picks within the two spaces if you mentioned any. Private banks, what do you like? And FMCG, what do you like?
I think the leadership will remain with ICICI and Axis. I think unless HDFC starts making a bit of a comeback, HDFC is now probably stabilized. I think probably the worst is probably behind. I hope so. Fingers crossed. It has a large weighted index. Probably while their deposit growth is pretty good, the market probably wants to see quarter-on-quarter credit growth. The asset quality has never been in question, and bit of, if I can use that word, animal spirit in HDFC, which markets was used to when Aditya Puri used to lead as a business manager. I think got to see industry leading growth. That's why you will get a 3-4 book multiple. You not get a 3-4 price book multiple for 12-14% kind of a growth. So we like ICICI Access. I think Kotak could be a tactical short term bounce, because my sense is the impact to EBIT as management guided is hardly 2 to 3%. I think they're working hard. The results have been pretty good. I think Kotak reported a good set of numbers after again a long time. And it's a smaller balance sheet compared to SDFC, 4 lakh crores. So it's easier to, if you want to get into an aggression mode, it's easier to clock that kind of growth. Asset quality has never been in question. So it would be ICICI, Axis, SDFC, and Kotak tactically.
Okay, so ICICI, HDFC, Kotak, those are the stocks within the private banking universe. But Gurmeet, what about the darlings of the stock markets? And they have been the PFC, REC of the world and the other power companies and power finances, even IREDA for that matter. They are taking a tumble today because of whatever news flow is happening. But would you be a buyer in these dips?
See, actually, you have to differentiate between different NBFCs, right? So one is an infrastructure lender like IREDA. Then you have companies like REC, PFC, which are more into project finance and power-related lending, right? And then you have the normal NBFCs. See, you have to understand the asset classification and the provisioning norms are very different for a normal bank and NBFC versus these entities. And any tightening by RBI. Now today there are just norms of project finance provisioning being increased of let's say 5% once the project starts. And if you're in a consortium, you have to have let's say have a 10% kind of an exposure. All of them does increase your capital adequacy and provisioning requirements. And they have run up, if you see from the lows, I think quite a bit. So these kind of events can happen. That's one risk you always run with when you go for these entities. So my sense is that you've got to be very selective. I think IRD still looks good to me in terms of the pipeline they have. Secondly, I think I would be better off going into banks right now because you get let's say these players at 2-3 book value, and you get good banks at let's say 2 book values. What would you prefer? So it's again a question of relative valuations. You can also look at some of the tier 2 banks like Federal Bank, around 1.1 book value, uh, doing good progress. I hope RBI also sees a turnaround. It's showing some signs, although probably I think this will couple of quarters away. And maybe some good NBFCs, proper NBFCs into consumer lending, like Poonawalla. We added one which we discussed last time, which is Ugrow. They just raised a lot of capital from family offices and funds. You're probably raising more. Almost 45% book is co-lended with banks. Very good ROAs, controlled credit costs. So these are the spaces we like more. I think in this pocket of power finance companies, state lenders, there's no harm in taking some money off the table.
So those are some of the microfinancing names, but I'm trying my luck here. Gurmeet, have you tracked any of the primary action candidates of late? This week, of course, Aadhaar, TBO, Indegene come to the market. Anything that you have tracked and liked?
I think Aadhaar is creating a lot of excitement in the market. We've been speaking to a lot of merchant bankers, family offices. There's a lot of excitement even on the book building side. So that's something we are keenly watching. But being a PMS, we have restrictions in terms of applying for the IPO. So we'll possibly look at Aadhaar maybe post listing. And there are some counter cyclical names we are looking at. Something we're probably seen bottom, whether in chemical, whether in IT, maybe selectively in healthcare. I think that space is looking good. We're trying to be a little counter cyclical there, hoping that maybe a lot of bad news is in the price.
Okay, point taken. So that's the view coming in. Gurmeet, thanks so much for joining us today. A quick.
If you like this video, then like, share and subscribe to ET Now.